I've been paid in share for the past 15 years. Stock options, RSUs, ESPPs, you name it. That's why today I'm telling you all about it and giving you 3 reasons why it's a great way of getting paid and building wealth. And also why you should think twice about accepting. Because it's not all roses and unicorns. There are negatives, dark secrets, and you should be aware of it. My name is Johan from Economia. Welcome back to the channel. Let's get started. I got my first RSU in 2011 and I was thrilled. This company believed in me so much that they were giving me ownership, well, a small part of the ownership of the company. That was such a motivator to work harder and give back because they put so much trust in me. I was really excited, to say the least. And what is an RSU, you might ask? It's a restricted stock unit. So basically, you're getting some shares as part of your compensation. And you're getting them on a certain date. This is your grant date. And you're getting them over time at a given date. That's called your vesting schedule. Let me explain how it works. Let's say you're getting $10,000 worth of company A shares at $100 a share, and your grant is on February 15th, 2024. That's your grant date, but you're going to start getting 25% of it in August of 2024. Then the next one is going to be on February 15th, 2025, then 25% on February 15th, 2026, and the last 25% on February 15th, 2027. That's your vesting schedule. The vesting amounts and the vesting schedule depends on the company you're working for. Sometimes you vest in 2 years, sometimes in 4 or 5 years. And what's really interesting is that even if the shares are worth $100, when you're granted them, over time, the value can increase by 20, 30, 50 or 100%. And that's where all the interest is, and that's where the motivation is coming from. And this is different from stock options. Stock options are options which is the right but not the obligation to buy the shares of your company at a predetermined price during a given period. And this period goes up to the maturity of the option until the date that the option disappears. Let's say that you are getting the possibility of buying the shares at $100 during a 4-year time period. And during that time period, the share price goes up, let's say to $110 or $120. That gives you the opportunity to still buy the option at $100 and pocket the difference. Whoa, I understand, but I have to put the money out to be able to buy those shares, and how do I get the cash? And how do I pocket the difference? Usually when you exercise an option, the stockbroker who is holding your option is going to do the following for you. Once you push the button and say, I exercise my options, they're going to go and do exactly that, exercising your options, which means they're going to buy the shares at the predetermined price and immediately sell them back on the market, and you're going to pocket the difference minus the fees. And to finish, we're going to talk about the ESPP, Employee Stock Purchase Plan. Basically, this plan permits you to use your cash compensation, to buy shares in the company that's employing you at a discounted price. And usually you can buy it monthly, and you have a maximum you can buy during the year, maximum amount you can buy during the year. So basically, it's a way for you to convert your cash into shares, and you're aiming to profit from the difference between the discounted purchase price and the actual stock market price whenever you decide to sell your shares. When you become partner of a company, this motivates you to work smarter, harder, and more creatively, because any positive impact that you have on your work reflects back in the company profits, the company share price, and eventually this comes back to you as being a part owner. Now that you're part owner of the company, you want it to do well, and do well for the longest time possible, because this is going to influence positively its share price. That's why you start thinking differently. You start to act for the long term. You are more strategic in the way you're thinking to benefit the company and yourself. One such example is how you build long-lasting business relationship by listening, understanding your customers. What are their challenges? What makes them successful or not? And find ways to help them. Maybe it's going to take time. Maybe you're not always going to have quick wins. But if you do this repetitively and become useful to them, advise them, and don't try to sell your product or service and shove them down their throat, you're going to develop a trusted relationship, long-term business relationship, a good business, and maybe, if you're lucky, like in my case, some long-term friendships. And in return, it's not only business you're going to get introductions to new customers. You're going to get feedback on your product and services, how to make them better. They may introduce you to a whole new network of people you never had access, and it's going to help you professionally and personally. And there's another one that's a favorite of mine, is whenever an issue arises. And believe me, I've been working for over 20 years, and issues always happen, and you're going to have to go make excuses and make amen. And that's when those long-term trusted relationships make a difference. Because even if you still have to make payments, payback, if you still have to apologize, the issue is going to be solved so much quicker because you have this trusted relationship. I've been through a lot of those, and trust me, it's so important to have those relationships. And actually, some economists have done some research on B2B and B2C relationships, and they have seen that when you have issues arising, actually having this long-term relationship really helps. I'm leaving a link down below with all the details. Another example is trying to make the company more efficient by reducing red tape. You work at the company, so you know where the improvements need to be made. By doing that, you're going to free so much time for everybody, so everyone can concentrate on making better products, better services, or taking care of those long-term relationships as well. Again, a win for everyone by having a long-term posture. And by doing so, over time, you're going to please your customers, making your products better and making the company more efficient, more profitable, impacting in the long run its share price. It's a win for your consumers, for your customers, your business partners, all of your colleagues, and eventually yourself. Your income is your #1 tool to build your wealth, according to many, as you can see now.
The #1 wealth building tool that you have is your income.
And it's actually even truer if you are paid with equity on top of cash compensation, and if you are doing it well. By doing it well, I mean living off your cash compensation and saving all the equity you are receiving. Equity compensation is impacting positively your wealth building, according to this research by Charles Schwab, and it can represent up to 40% of your wealth, depending on your age group. And it manifests itself with what is called a big payout, when the value of your equity completely exceeds the value of your cash compensation, and when this value is many times higher than the value it had when it first was granted to you. That's why you see employees of successful startups or high-end executives being millionaires just by the fact that they kept and they saved their equity over the long run. I have personally been able to save in the high 6 figures by never touching the equity that I originally received from that company, and it's now worth many times over. Now, come closer. Let's be honest. It's not all roses and unicorns like I was mentioning. There are risks. They're real, and you need to be aware of it. And the first one is the value of the stock is never guaranteed. You're paid in stock. You're receiving shares, whether it's stock option, RSUs, or you buy them with ESPP. That's great. And you are expecting it to go up. But again, the company can still fail. The market can go down. There can be scandals or issues that are completely outside of your control. And the shares can go down by half, or 10%, or 100%. And you're going to be left with nothing. Think about Snap. or Coinbase. People haven't made money out of it. The other thing you need to consider is tax. This is going to be very depending on where you live and a lot of different factors, but you really need to think about it. Because in the worst case scenario, you may end up with not enough money to cover your basic expenses. Let me explain. If we're talking about RSUs, you have the grant date and the vesting date. Usually, when it's granted to you, you do not have to pay any tax. In most countries, you're going to be taxed during the vesting event, and then it might be considered as regular income, meaning you're going to be taxed on income tax, and it can go high up very, very fast, but you're just getting this vesting, so you actually don't have cash on your hands. To have cash on your hands to pay the tax on those vested stock you need to actually sell them. Then you get the cash to pay, and when you sell them, if you have made some capital gain, guess what? You need to pay capital gain tax. And if you are in a country with a very high tax rate, like myself in Japan, anybody in Europe or northern countries, then that can bring you to a higher tax bracket, and you can end up with less money after tax than you had before being paid in equity. So this is something you have to be really aware of, because it might be very complicated, and it's even more complicated with stock options or ESPP, so don't get me started on it. You really need to talk to a tax accountant and be really sure that by getting paid in equity, you're going to be better off in the short and long run than you are without being paid with equity. This one is often overlooked. Being paid in equity means that your compensation is delayed over time, 2, 3, 4, 5 years. And if you perform well, you get new grants every year, pushing back this vesting period. And you end up waiting for it to come every year a little bit more. Could be very interesting, but you might be compelled to stay even if your job is not so interesting anymore. If the company culture changes, if your new manager is actually not such a good manager, if the people around you are not the people you thought they were, and you're staying there just because you're waiting for this big payout. That's what we call golden handcuffs. And if you feel you're in this situation, take a piece of paper and put 2 columns in it, the pluses and the minuses. And if there are more minuses than pluses, then it's time to look at yourself in the mirror and ask yourself whether or not you're really happy in this company, whether or not you're true to yourself, whether or not you are being selfish and actually putting your loved ones into a bad situation because of where you're working. Is it really worth it continuing? And wouldn't you be happier working in another company, forgetting about this big payout that may or may not come? I've been there and didn't even know it. Trust me, you need to take a breather and ask yourself those tough questions. You'd be happier afterwards. Equity pay is the summit of high-paying job and jet-setting careers, no question about it. But it comes with strings attached, and it's up to you to decide if it's worth it. If you're interested in more finance and investing videos, please check these out. If you like this content or learn something, please give it a like and don't hesitate to subscribe for more to come. And if you have any comment, please leave it below. Thank you again for watching, and until next time, goodbye.